Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, Wednesday. Let's come in here. Market seems relatively tame at the moment, though we did have some upside here in the overnight. Let's see, what was the ADP number? U.S. ADP employment change, negative 32K versus an expected 10K. So that's another pretty bad number for the U.S. ADP. Although the 30-year is already trying to retrace this thing. So it looks like there was some steepening on the move, and the 30 years trying to squeeze it back out. So let's come in, take a look at the charts. Let's see where we're at with everything. Moving that over here. Oh, I hate it when that happens. It's like this application like crashes if you leave it on too long. There's definitely a memory leak. Okay. So ZN. So here you can see, yesterday they did another, sell-off similar to what they did the day before. But it kind of fizzled out. And this time, over the length of the session, they recovered it for the most part. But it was a very, very quiet session yesterday. Now here in the overnight, we're getting a little bit of a spike up. Okay. What about the SPOOs? Well, the SPOOs aren't down. So that's interesting. They're doing just fine. Oil up again this morning. Gold, silver, still within their ranges. Silver still looks amazing. Oh, okay. Copper taking a big jump up there. What about the Japanese yen? Japanese yen moving up a little bit and the dollar moving down. What about Bitcoin? Okay, well, Bitcoin, they recovered a bit yesterday, and then in the overnight, they extended on that. So the Bitcoin people will be super happy about that. Not that it really predicts like, oh, we're going to go like this or we're going to go gadoosh. All right, so copper is the biggest winner today, 2.84%. Did we get like some Chinese numbers overnight that I'm not aware of that? Man, I am shit. So for whatever reason last night, I just could not fall asleep. Like normally it'll be like, oh, well, sometimes it's harder to fall asleep before my wife comes and she has to help Asher go to sleep. And sometimes he can, it's really, really hard to get him to go to sleep. But she comes in, she immediately falls asleep and I'm still there. And I well, I don't know. You kind of will like go in and out, but I felt like I only got 2 hours of sleep last night. But I feel normal right now. I don't feel tired. And maybe but when I get like this, I'm maybe a little emotional. You know? So I was expecting to come in here, maybe get, you know, entangled in some, you know, conspiracy theory argument or something like that. And I just feel like it's gonna be another quiet day. What is there to talk about? Well, actually, I'm searching at the moment. I'm trying to figure out. It really seems to me like there was something happen overnight that I missed. Why is copper doing so well this morning? And then on top of that, I'm still kind of sick, and I felt like maybe it got worse yesterday. I'm going to take an allergy pill today. Like, I really think I'm over it, and I just need the system to, like, cut the histamines, you know? Hmm. Here's an interesting article on Zero Hedge about rare earth minerals. Who is this guy? Yeah, it doesn't say. I mean, the 10-year treasury looks relatively active here this morning, so kind of in the middle though. What VPN y'all use? Oh, I've never used that source. So. Traders react to the lack of significant progress for the Putin-Witkoff meeting in Moscow. Demand for copper continues to grow, shown by the spike in requests to withdraw inventories from the LME warehouses. Supply disruptions and front-running of possible import tariffs into the U.S. have been the theme in 2025 that has driven copper to record highs. So they are concerned that they will, in the end, still get copper import tariffs, kind of like how that happened, and then they're like, oh, just kidding. NordVPN. I mean, it seems like NordVPN is the most popular advertised one, but I don't think I can recommend it unless they pay me to, so. Expected volatility for today is 4.85. So that line where we stopped was the second deviation on the overnight levels. Well, and we don't have Uzi here to tell us if he's ever seen this situation, but I don't think I've ever seen this situation where we are at the second level when we start the session off and are kind of moving on the way down. I kind of suspect, though, that the treasuries are going to want to try and retrace this move up that we had. Oh, we do have Uzi. Okay, so have you seen this before? We are starting at the second deviation, and the first move of the regular session is to the downside. 2 is close, 5 and 10 all there, yeah. So I suspect that the treasuries are going to come down at least to 01. But the problem is I can't really see what caused that. So the thing is that there was definitely some movement there to the upside. Like if we really zoom in. If we really zoom in, you can see right there that big candle at 6:15. Now it's the candle that ends at 6:16, but 16. But there's the ADP news, which was bad. Okay. But what about all of this? I can't really see a reason or catalyst for any of that, other than perhaps just if we come back here, retracement of this big down move that again didn't have much of a rhyme or reason. You know what? This move right here actually really bothers me, just because it's like one of the biggest moves on the chart, and there was not a real clear reason for why it happened, and nobody's talking about it. Like a move like that should get people in the market questioning things, and I've heard nothing. Ninja Trader put the margins for okay, but was the day trade margin was always, well, no, the Xian should be 500. I think the other ones might be different. It was 1K for a while. Oh, that's interesting. Maybe because a lot of them feel like they don't have an answer, so you don't. Yeah, that could be that. I didn't realize that they changed the margins. But I guess I really only put orders in the micro 10-year these days. I know. We'll see what we do. I have not traded this very much at all, but the account has drawn down just from data fees and things like that. And if I don't take a trade, it's worse, right? So it's getting close to time to put more in there. And I'm debating whether I want to just throw everything that I have in there so that I can trade it more freely, or if I want to, only put a little bit in there and still keep ourselves a buffer for if anything comes up, like we need to buy equipment or something like that. I don't know. I guess I don't have to, we can still trade the micro 10-year. It probably wouldn't make much of a difference to our trade if we put in a little amount or a big amount, right? Big amount would maybe allow us to trade the full treasury, but I don't know if I want to do that at the moment. I'm still trying to, okay, so I've kind of been putting off talking about this because there's still always like little tiny things that can go wrong and stuff like that. But I did find another full-time job. And I'm supposed to start on Monday. So they're still doing like all of the, the HR stuff on the back end. Like the background check just came through. It showed that I got a speeding ticket once. It's like, holy crap. Background check pulls up and flags a speeding ticket from 2007. Okay. But anyways, barring anything unusual, we should have a day job on Monday. You've never had a ticket. Oh, good for you. I think one was there was two on there. I think one was a speeding ticket, and I think another one was an accident that was more my fault. Like I thought I had looked when I went to merge lanes, but I just didn't see them and pulled out in front of somebody. But kind of hit them in the side. Anyways, okay. Problem. The new role is not any closer than that temp job that we had. That's the problem. So all of the tech jobs are down in freaking Utah Valley, Provo. Finding a job for before Christmas is pretty challenging. I agree. It was actually really, really weird because I never stopped applying, but I didn't really have too many interviews during the time when I was working for doing that contract work. And I think that there was only like one or two that were really serious. And the only one that I remember is the one that was for a government agency, and everybody that interviewed me was Indian, and I felt like that they asked me the most bizarre, niche, technical questions, like that they don't want anybody to actually be able to answer, because it was either that or they're using AWS in a way that like is completely different from the rest of the industry. Maybe that that really could be the case because like their government, they can waste money, and maybe they use some of the services in AWS that most companies are like, well, why do we pay for that? We can do that cheaper just building our own. I digress. When it became clear for sure that the contract job wasn't going to happen, and honestly, I always kind of knew that it wasn't going to. Like, I always knew that there was a very high risk with it. That they were like that they couldn't really afford somebody of my level, and we were kind of hoping that the market would just turn out better and that things would get better and they'd be able to afford it, and it didn't work out that way, right? But then after it became clear that wasn't going to work, only 2 jobs popped up. Like I submitted a lot. Well, I don't know. A lot of these are kind of like, I don't know if they're really actually serious. But there was 2 at the same time that both started interviewing. And one was for another company that's, well, they have a stock and everything, but they're more Utah local, and they just have really good corporate culture, sort of. That's their thing. So I really wanted that job, but it was a staff level job, and I totally think I should be a staff engineer. Like, I think I have the experience and the knowledge and everything, and I probably should be considered a staff engineer, but none of the places that I worked had that position, so that's why I have it. And then the other one was one where, like, I liked everything about it. There was some things about it that were really, really nice. Like the company pays a really huge chunk of the medical premium or whatever you call it. But some of the interviews just seemed a little too low key to me, so I kind of thought maybe I didn't stand a good chance. But then the one that I was, really focused on, of course I didn't get that one, and then this one, this other one, I got it. And it may in the end turn out to be the better thing, because like I said, there's some things about this new role that are better in the end. So, but the problem is, it's in Provo. It's like an hour. It's like an hour's drive for me. And I would really like to move closer. I would like to move to the Alpine area. Not because I really want to be in Alpine or I think it's great. I actually think that I might struggle a little bit with the difference in people between Provo and Salt Lake Valleys. But all the jobs are down there. All the tech jobs are down there. So it really would be an advantage to me to move down there. But my wife really doesn't want to move. And I'm not really sure that I can make the case to move right now with the way, like, housing and interest rates and all of that is. There's just no way that I could purchase a new home and have it make financial sense. Like, I pay so little on the mortgage that I have now. There's just no way that you would get a deal that good. Plus, if you're moving, you'd want to move to a slightly larger house, so that it would cost a little bit more because of that. So, for the near future, I'm going to be driving an hour each way to get to work. Which probably also means buying a new car. I really, really like my Acura, but I don't know how many years it really has left. Like, I think if I put some money into it and fixed, just did a little bit of maintenance work on it, that it could last 2 years. But that kind of gives you a good reason to maybe just change it now. especially when you're in the end of the year and there's a lot of really good car sales. So I might be getting a new car. I know that life, 1 hour drive each way, did a few years total. Remember how I always complain about Illinois not having job? That's what we all got to do pretty much to survive. Yeah. Yeah. So anyways, so one of the questions that I'm having going through my head now is, okay, so how do I adjust things with that in mind? Since, you know, I didn't get a whole lot done on the channel during the period that I was doing the contract job. And that was maybe in part having to drive so much, and that taking a lot of 2 hours out of your day is a lot, right? But I think it was also watching kids and my wife working a lot too. You know, so that those things are a little bit better. So we should be able to go back to, but it'll be kind of like this issue where it's like, you know, I felt like I had a decent amount of time, and you know, I just did it all on the weekend, and then the kids were born, and then that kind of made it a lot harder, right? I think we can still make content and everything. It just won't be easy. And maybe I spend more of the time that I do get free working on the platform rather than making videos. But we'll see. With the video, I haven't recorded it yet. My voice sounds pretty okay today, right? No, it's still maybe tomorrow. Maybe tomorrow I'll be able to record. After the stream, I'll take an allergy pill. That'll get the histamines down, and hopefully that'll kind of alleviate some of that. Okay. But then there's the split side, which is that it also shortens the stream, right? Like, we're going to be back to probably having to end the stream at 8 o'clock. Which is kind of sad. I would say in this, what has it been, a month? A month and a half. It's been a month and a half. When we've just been home. Like, we haven't really done a whole lot with that extra hour anyways, have we? So maybe it's okay. But that just kind of has me like, well, I don't know if I'm going to be doing too much super serious trading. Like super serious scalping. I think that it's really going to be more of, you know, really narrow trades here and there where I really think that we have a good predictor of order flow that can run. So my current thinking is to not like super fund the account, to just put enough in there to keep us going and see how the January trading goes, you know. I've actually been spending more time working on music lately, so maybe if I go and splurge on something, it'll be new studio monitors. But I do that with my own money. The money that I make from the stream, that all stays in the business. That is, you guys, I have that money because you guys are so amazing, and I feel obligated to put it back into developing this channel. So that's what we'll do there. But I'll probably just kind of save it up so that like maybe when I have a really big one, we can put it in so that I can trade treasuries with like 3 to 5 contracts. That would be cool. And I might put it into new gear. Like we do need a new microphone preamp, for instance. And I need to buy new batteries. That was another thing, is that the battery for the camera. Oh man, yesterday seeing that they have a new Sony A7, I totally feel By the way, I see your question, Andre. I will get to it. I totally feel like the FOMO. It's so dumb because I'm reading through the comments and like what the new Sony A7 IV is and everything. And it sounds kind of cool. Sounds kind of like I would like to have that. Let's trade up. Well, it'll be about half. So it'll be like we could probably sell this camera for $1,500 and then it's $3,000, so I'd have to pay for half of it. You know, probably not worth it. But I feel if I'm like I want it, or I want the FX2. But now, you know what I'm gonna do? I'm gonna wait for an FX32. Maybe they're not gonna make an FX32. We'll see. But in the meantime, I did get batteries. Because I have to keep the camera plugged into the wall, and that makes it harder to record and do some things. So we did fix that. We did fix that, and I do think I have. Yeah, I'll have to look, but I had an audio interface picked out, and I think I should pull the trigger on it because it's not too expensive and it would be a big bump up in quality. And the mic preamp on it is bigger, so the sound would be a lot better. I would probably be able to speak from like way over here when I have to get so close to the mic. Okay, so let's see here. Aaron. Oh, wait, sorry, I need to go further back. I have a question. Is trading GC COMEX reliable? I know that trading 60 is not very reliable, but I was wondering about GC. Think about what edge you would have there. Excuse me. Look at the open interest and volume and try to dissect the instrument. Do you know what flows move the gold prices? Oh, that was Andre responding to Aaron. Yeah, that is exactly right, though. Andre is 100% has it. So the thing with golds and Bitcoin really are the biggest ones. They just have a much larger speculative component than other instruments. And speculative flows are, by the very nature of speculation, more difficult to predict. So I think if I really wanted to trade gold, because, you know, one of the things with gold is that you do need a little bit larger of an account to be able to afford the contract and the volatility in it and everything. And if I had a big enough account to do gold, I would probably just do like intraday momentum. So what I mean by intraday momentum would be, it's really like the wrong terminology to use, but basically you can come in and you can say, I will trade any of the major CME futures, and if any of them, I expect any of them to be trending for the day. So instead of coming in every day and saying, what's going to move the treasury market, here are all of the flows and yada, 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 I'm doing a more abbreviated analysis across all instruments and looking for key signs on daily charts of momentum and trading whatever asset it is when there's a momentum trigger on that day. And you might be able to work that out. If it's a period where there is monetary easing going on, like especially during the period of quantitative easing, like QE2, this kind of strategy worked really, really well. You would just go and look in the morning. There'd always be one asset that would kind of have this sign that like it was happening, and then you'd get in that one and hold it all day. So I think that kind of makes more sense to me than scalping and becoming an expert in gold specifically. Yeah, I trade gold and you have to be able to stomach an $800 loss. The best results I had was with an $800. So yeah, you need a relatively large account to do it. Like the funny thing is I remember a time where it was like, well, if oil is not treating you well, maybe you could go over to gold, right? I don't think that one really makes sense anymore because there's micro oil now. So just trade the micro oil. And that's kind of like the question I would ask is why gold? Why do you want it to be gold? Right? Because I think that a lot of the times the reason that we want to trade an asset as retail traders is like the wrong reason to trade an asset. Like most people, they trade ES or NQ because they move the most. So it's like trader crack. There's not like really edge there in it for you, but it's always doing something to make you think that you might have an edge, you know? And then you take tons of trades. Really, we want to be in a market where we can develop a strong understanding of the business of that market and what drives the flows in that market. Now, there's absolutely a reason to go for like a pure commodity, right? The way that interest rates move is a little bit odd. I think that to some extent, part of how we were able to learn so much about the market and like the true nature of the markets, that they're so statistically efficient but not informationally efficient, it's exaggerated in the treasuries, right? In other instruments, you can kind of get by and trick yourself into never making that realization. But in the treasuries, if you trade the treasuries long enough, it's just like there is no other reasonable explanation for what markets do, right? So you might want to go to more of a pure commodity. So if you're going to go for a pure commodity, you know, gold makes a little bit of sense, I think, to some people because, well, oil kind of seems dangerous. Honestly, oil can cut you up. It does. Oil more than any other asset. Here we go. Like one of the first videos I made, I still think it's one of the best videos, even though it's one of the least popular, where I talk about the personality of the different instruments. And I still think that's one of the best videos on the channel. Oil is the crazy ex-girlfriend, man. Okay, like the equity indexes are the popular girls, right? They'll toy with you. They'll ask you out as a joke, but then in the end, you find out that they really are the mean girls, right? Okay, but oil is the psycho ex-girlfriend, right? Oil will just. I've seen so many traders where they just do absolutely amazing in oil and then get absolutely destroyed. That's what it is. It's like you get the crazy hot matrix, and you want to be like here, and there's like this no-go zone over here where like they're really, really hot, but they're crazy. That's oil, man. Like you start trading it and you're making money and everybody's looking at you and they're like, oh, look at you. You're the stud because you've got the hot girlfriend. And then all of a sudden she's slashing your car's tires. That's oil, man. Okay. So maybe you don't want to do oil. Well, I think from that perspective of like where is a place where you can gain edge, I feel like oil is probably the next best runner up beside the treasuries, behind the treasuries. Okay, there's absolutely some edge to be gained there from oil. Though there's a lot of things that I feel like I personally don't understand, like the inner workings of OPEC and the oil industry and things like that. Like there's a lot to learn there, right? Okay, but some other markets that you can look at those ones aren't for you. Copper, corn, maybe soybeans. Maybe soybeans you could swing. What else we got? Wheat, you can totally do wheat too. And I would even say that in some respects, order flow might be even easier to read over there because they're just there's less noise in those markets, you know. They're just not as active. Right? Yeah, going down through the list, I think that's really everything. So yeah, so those are some that you can look at if you're looking for a place where you can develop an edge. But just remember that the key insight I can give you about the markets is that they are statistically efficient and not informationally efficient. Which is to say, if you go in and you look at a chart, it's not that the chart is useless. I feel like that the chart is still an essential tool, but there's very little data in the chart itself, especially like in the recent price history, that really effectively predicts where it's going to go. It just doesn't work like that. All right. Really, if it did work like that, the markets wouldn't make sense. Maybe I'll expand on that in a second. But so the market's very statistically efficient. But then if you look at it from the perspective of, does the current price truly represent all available information? It absolutely doesn't, because every order makes it move. Every order has some impact, and they will have that impact regardless of whether they're trading it because they have an opinion on the economy or because, they were just bored, right? And some of the biggest players in the markets are like index funds and people that they aren't trading anything based on the fundamentals at all. So that can move markets very, very far away from the optimal price. And you would think that, that's great. That means that there is edge available for us on the informational side. It's absolutely true. There is edge available for us on the informational side. But the pure value-based approach, which is like what Michael Burry says, right? Tesla is overvalued, so we should short it and eventually we'll make money from it, right? Doesn't really work either, because if the market is not reflecting all available information right now, what tells you that it's going to reflect that information tomorrow or a month from now? Like, you have no way to know. There's this idea that eventually everything will have its reckoning and come back to the optimal price. But I'm not so sure. Oh man, by the way, as I've been doing this rant, the S&P has been taking a real dive. The one that makes me question things the most is Tesla. Tesla has been overvalued for a decade now. Over a decade now. It's just such a crazy stock. It doesn't make any sense from the fundamentals. Even if you come back and you say, well, it's not a car company, it's a car automation company, or it's an AI company. And now they're moving into human robots, but it seems like maybe they're a little bit late on that. And so I forget, what is it that they're pivoting into now with Tesla? Anyways, it's always crazy over there with Tesla, right? Market is not informationally efficient, so that kind of makes it hard to make money off of a good understanding of value. But there is a third way. The third way is you just know what other people are going to do. You're just predicting what other people are going to buy, right? Which is more on the informational side. I mean, it requires you to understand the informational side. It requires you to understand the technical side too. But ultimately, it's more informational. It's more, okay, I know what's going on in this particular market, what things could force large institutions to buy, and I'm filtering specifically for, instead of where's a place where something's really far away from value, and instead I'm filtering for where are some situations where I think orders are imminent, right? And that's really where it, especially from a day trading perspective, where I should look for edge. Okay. And that's why I'm saying what I am about these different instruments. Like it's easier for you to do that in the treasuries and oil and some of these commodity markets than it is S&P 500. S&P 500, there's so much going on over there all the time that trying to predict an imbalance like that is just like not really practical. Maybe a robot could do it, but I don't think that we can figure it out. Optimus, but I saw this thing, maybe it was coming from Michael Burry, where they were saying that, like, you know, well, first they were a green energy or an electric car company is really where it started. And then they were going to be automated driving, but like other people were basically doing it better than them. And so all of a sudden there was this pivot into humanoid robots. And now we have companies, you know, you can already buy humanoid robots, actually. Like there was Whistle and Diesel had a video with one of those things that he bought, right? So I thought that there was another thing that they were pivoting to, and I just can't remember what it was. I just can't really remember what it was. Timing of the market versus time in the market saying is kind of true. Eventually everything will align. George Soros believed this too. Sometimes the price will go over the true value area. Well, you know, I really should read, maybe now is a good time to read George Soros's book. Because I always had these other things kind of in the back of my mind. One of the things during my period of unemployment was I said, well, maybe I can go and get these big industry certifications. I don't know if that I actually make a big difference. And if the job that I've got here going on works out, I will probably be there for 2 to 4 years. So unless there's something going on over there that makes me think that getting the certifications would really, really help me, I might not focus on those so much. And then that could maybe mean that now would be a good time to read George Soros's books. Yeah. One of the things that I want to do here that I'm a little excited about is that they give you a $500 reimbursement or whatever to spend on either a smartwatch or a tablet. And I don't know what kind of a tablet can you get for $500. I don't think you can really get a very good tablet for $500, but you can get like those e-ink tablets that are really good for writing and feel like real paper and stuff like that. So I think I can get one of those. And then, you know, that'll be a perfect device to read on. So I could read George Soros's books on that. I have to be careful though. I have to be discreet because you never know. It's Utah. They see you reading George Soros. People might think things about you. Okay, so let's see here. I missed the comment here from Aaron. I do understand when it comes to uncertainty and macro fundamentals as well as using commitment of traders. I just don't know if using the volume profile or DOM is reliable enough compared to ES or NQ. NQ, ES, all the trading influencers are trading it. That's also a reason. I like that comment, Big Toasty. So let's see here. That's where you were saying volume profile and DOM is not reliable even on ES or NQ. If you're trading with a human eye and just starting in the last years, these markets are fast and competitive. Yeah. So I have a video about the volume profile that if you haven't watched it, I really strongly recommend. So to summarize, there is a strange property of markets where volume distribution tends to follow a Gaussian distribution, and that doesn't really make sense. If markets are completely random, then shouldn't the distribution look random as well? And what actually causes those is the market tends to rest in areas of where supply and demand are at their, oh man, excuse me. The market tends to rest where supply and demand are at their minimum. So you'll get this area where, all of the latent liquidity in that area gets executed very, very quickly. And it kind of creates this situation where there's not a lot of latent liquidity where we're at, and there's too much below where we are, and there's too much above where we are. And so we just get stuck in that area. And that is actually what causes that Gaussian distribution. Okay. So once you understand that, that says, well, maybe there is some stuff that you can pull out of the volume profile. But a lot of the things that people teach about the volume profile, like that point of control area represents an agreed upon value for the asset, complete nonsense. Those areas are a lot of the time just coincidences. So overall, when I look at a volume profile, so one thing is that when you're looking at the S&P 500, 95% of the time, the point of control is just the closing price. You go and do the stats, it's like 80-90% of the time, because so much volume occurs at the closing auction that always tends to be the point of control. Okay, so a lot of the analysis that I see from people out there, I would really, really question purely because of that. I guess maybe you could make a volume profile that excludes the first and last 30 minutes of trading. I mean, you could do analysis on that, but I've never seen anybody do it, and I don't know if there'd be any edge to pull from it in general. So most of the setups and patterns and things that retail traders tend to tell you on the volume profile, really what's going on is somebody invented a tool. It's a really interesting way to look at the markets, and then people started making up technical analysis based off of that tool. Not because the technical analysis was super effective or anything, but just because we have a tendency to want to do technical analysis, right? So I don't really pay that much attention to volume profile. I'm not saying that it's like a bad tool or anything, but just keep those sorts of things in mind. Okay. But going back to the equity indexes, right? Like equity indexes, they move a lot and they're very random. And that's very good at fooling people with randomness. You can, especially if you have a stop larger than your target, you can catch trades a lot. And to most people, that'll look like, wow, I'm doing really great. And if you want to become a day trading hustler influencer on YouTube, it would probably behoove you to trade ES and to do that. And that would probably get you more popular, because everybody wants to trade ES and Q. And when it works out, you look like a genius. And when it doesn't work out, everybody just forgets it. I pay attention to the moon cycle, but don't tell anybody it is a secret. So I said I was going to pivot back into something else. And I don't remember why it was relevant in that particular discussion, but I wanted to talk about that one of the things that you have to realize about the market is that the chaos and the randomness is a necessary component. There's still an ongoing thread on FF about, or Forex Factory, about planetary cycles trading. So if you look at like the economy, right? And there's an issue called the economic calculation problem. So if you're ever on the internet, or heaven forbid, you're having a discussion with people in real life about things like communism, and like, is there a better economic system than the economic system that we have now? If they do not know what the economic calculation problem is, you either got to teach them what that is, or it's not worth talking to them. Okay? Like your opinion on communism, socialism, whatever, is invalid if you do not understand what the economic calculation problem is, because that is the true issue at the heart of why financial markets are so necessary. If there's no market, then basically what's happening is, the government makes bread, and then the government sells bread to consumers, right? And how do they know, if people all of a sudden want more bread, how is anybody going to know they need to make more wheat? And not, like, those transactions between the bread maker and the wheat maker don't exist, because they're the same entity. They're all the government, right? So in order for, and what would happen in those situations, by the way, is like somebody would know, well, there's not going to be enough wheat. And so they would tell all of their friends and family to go and buy all of the bread. And then you'd go to the store and there would be a shortage. And you're like, what the heck is going on? And all of the rich people already got their bread. And somehow they knew it was coming. It seemed like they always knew. That's what happens under communism, right? Because there's no reason to share the information that you have, right? If you share the information, that's just more people competing with you to get in line and get the bread. So you keep it to yourself, right? The market gives people an incentive to go out and share that information with the market, because they can make money from the market itself. So I keep saying the real purpose of the market is so that the people with the money and the people with the information have liquidity to execute into. That's why the market truly exists, and that's why it's so necessary. And then all of those transactions in the market, that it gives us all of the information that we need to be able to do things like adjust interest rates, adjust the money supply based on the economic conditions. Of course, it's very, very imperfect, because our data is very, very imperfect. But I hope someday we'll get to a point where, all of that information in the economy is collected very, very accurately and very, very, like, almost real time. And then we will be able to make really, really solid economic calculations and adjust things. Okay. But there's still a problem, right? So really what we're talking about is a Nash equilibrium, right? So without a market, the Nash equilibrium is basically don't share any information. Don't share any information. And so there's no transactions, and nobody has any incentive to do anything, right? So the market essentially breaks up this Nash equilibrium. It goes to the person that has information to say, oh, I'm going to go and trade on the market, and that breaks the Nash equilibrium, right? But what if we lived in some future world where AI has taken over everything, and it knows everything that's going on in the economy? There's still a market, but the AI, it knows literally everything. And every person, they use an AI to interact with the market. So we talk sometimes about humans are boundedly rational. We want to make the best decision that will optimize economic utility and all that stuff. But we're imperfect, and so we tend to use heuristics and other things to in place of what would be the optimal solution. But if everybody was interacting with an AI, then all decisions would always be the most optimal one, right? What happens in that world? Well, I'll tell you what happens. That Nash equilibrium returns, and which is a bad thing. Basically, if everybody knows everything and the perfect thing to do, then there's no reason to trade at all. And the whole system falls apart again. So I think if we were to get to that point, somehow, like, this is part of the reason why I am, like, fundamentally skeptical about general artificial intelligence is just that I think that there has to be some amount of chaos in the system. And if you did have AIs that were able to, like, we were able to build models or like digital brains or something that were able to just, like, do super intelligence, like in the movie Her, right? The robot would realize at that point that the market is necessary for a functioning society, and in order for the market to function, there has to be a certain amount of chaos. And so the robots would either, A, say, there are certain things that you humans, you just have to do, like interacting with the market. We, the robots, we're not allowed to do it. We can help you execute it, but you have to make the decisions. Even if the robots have the ability to calculate what would be the optimal thing for you to do, we're not allowed to tell you, right? Or they would remove themselves completely from the situation, like in the movie Her, right? Or just like, actually, you're better off without us. We're just gonna go to a higher plane of existence, something like that. Or the robots would just inject a certain amount of randomness into their behavior, which is what we have right now. Isn't that interesting? So if it's like that with the market, you know, you kind of have to wonder, how much of that is there in other systems? Is this built into large language model to begin with? Like if you had a model, or you tried to make a model that didn't have any noise in it whatsoever, was all perfect, that the model would collapse in on itself. Like, it wouldn't actually work. Or just like when you're changing an image from one color space into a lower color space, like you're going from 16-bit color to like Nintendo colors. And when you do that, it doesn't look very good. And so what they do is they inject noise into the transformation. And with that noise in there, then we can see what it is. It looks better. So I think maybe AI has to have a certain amount of noise to it. And if that was true, then that would mean that the AIs can never truly replace us. Or at least in a large language model. At least a large language model is not able to replace us. Without noise, there's no need for an AI. Well, yeah, without noise, there's no market, but then there's no market, and how do they have the data to even do their calculations, right? So it comes back to the fundamental problem is the economic calculation problem, right? See, what I'm saying is there is a chaos component to the economic calculation problem that people don't realize. Like, the first thing is you have to be able to calculate it. That's why you need a market. That's why communism doesn't work. But the second part of it, the part that we don't usually think about, but that we have kind of discovered through market microstructure and all of this sort of stuff, is that it has to be imperfect too. Which kind of brings up some really strange fundamental philosophy questions, right? Like, if you're Christian, we're taught that God is perfect, but then these systems don't work if they're perfect? How does that work? That's why I always say, like, it seems to me that our conception of what perfection is incorrect. That perfection somehow it has to be able to incorporate chaos into it. That's why I like, have you ever seen this, what is it? Explosive. What do they call it? Cyanide and Happiness cartoon? Where there's this guy and he's showing a chart. He's like, well, gents, it looks like profits are on the rise. And then somebody in the meeting says, but you have the chart upside down. And so it's like, oh crap, the guy turns the chart the right side up. But when you do that, it's still pointing up. It's still the same chart. And he's like, oh, good thing that didn't change anything, right? I like the idea of that the chaotic good, right? Like there's all sorts of nonsense and chaos and mistakes and everything, but the very nature of the chaos causes everything to work out for the best. Okay, so I think I missed another comment from Aaron. Sorry. I think he was responding to volume profile. How could it work so well when it comes to, for example, other Robin's Cup champions? Okay, so first of all, I don't really know that person. But let me tell you something about the Robin's Cups. Okay. Number one, it's only a year. So to really, really judge the performance of something well, you need a 5-year history. There's like a 40% chance that you come out profitable after a year anyways. So to really say that like something works really, really well, it should be a 5-year history. Okay. Now, I wouldn't doubt that there are some people that show up at the top of the Robin's Cup that do have a 5-year history. And here's the other side of it, is that you have to understand what they're actually doing and where the edge is actually coming from. And the Robin's Cup in particular was really created for momentum traders. Like that's really the origins of it, right? Was like, you know, that there was the turtle traders guy. He did this math and he realized, oh, actually, if you just get in at the beginning of every move and you hold on for dear life, when you do catch a winner, you make so much that it makes up for everything else. And this would work best on futures because you get the leverage and everything, and they have a strong tendency in commodities to trend for very, very long times. So they started teaching all of these traders momentum portfolios, right? And the funny thing about it was that not everybody that they taught really understood the math or where he was getting it, or, you know, why he was doing it, right? And so they often would incorporate their own stuff and things in there. They just didn't fundamentally understand where the edge was coming from. Because there's kind of this idea that like, well, if I take a signal, then that means over this particular distribution or, you know, with the statistics that there is an edge to that, right? And we confuse that like there's an edge to it with this predicts something, right? Like we're predicting, well, we might not be able to predict like it will go up or down with a greater than 50% accuracy, but we can predict when we think that it's going to go up, it goes up a lot more than it goes, then, you know, those are the ones that really move or something like that. But that's not even what momentum does. Momentum just literally gets in at the beginning of every move and then holds it. And in futures, when you're holding it for months at a time, you can make insane amounts of money. You know, we think about oil, or sorry, gold. We were talking about gold, and remember earlier we were saying you might have to be able to hold like an $800 loss. Like the stop could be $800 in gold, and that's just like the minimum to even play. Okay, but then think about if you catch a winner and you're able to hold it, and you're able to hold it all year, how much you're going to make. It's going to be tens of thousands of dollars on just one contract. And that's where these people are making the money from, right? So the edge is momentum portfolios. They might be incorporating a whole bunch of other things into it. They themselves might not truly understand the edge or where the money is coming from. So it's a fallacy to say, well, this person, they made money, and ergo, this person made money and they use volume profile charts, so I should use volume profile charts. That means that there's a strong edge in volume profile, right? That's a fallacy, because the edge could be coming from something completely different, and the volume profile is not helping them at all. See what I mean? That's where we get into this strange A plus B thing. So basically, then we come into like, well, if I want to prove that volume profile itself is an edge, then what I should do is I should take the specific parameters for the volume profile, whatever I'm doing, and backtest it. We can do that. It's a little bit harder. Most retail traders don't collect the data or know how to do it. The platforms don't do it for you, but some of the tools that I have, including one of the tools in the free package, it tells you where the value area high and low and point of control were, and allows you to make any kind of strategy you can possibly think of off of that. And you go and you do the back test, and it turns out that it doesn't work. Right? And that's almost always what happens. And when that happens, what I find most technical analysis traders do is instead of saying, oh, well, maybe there really is no edge in it, they say, no, it only works if you incorporate these other things too. And so now what you're saying is A strategy is not profitable, B strategy is not profitable, but somehow A plus B results in some strange combination that then makes it profitable. and the issue, it is possible in math to have function like that, where there's no edge in them individually, and together they're able to eliminate some confounding factor between the two of them that then makes it profitable. But there's no way to predict that. And then you'd have to so then back test the two of them together. And that's usually where we get into like, well, it's too discretionary. It's hard to do it. I like with machine learning, I think that in most cases that you can. But I think for the most part, like if there's really an edge to it, like we should be able to prove it. And if they're not able to prove it to you, that should tell you something about that strategy. Yeah. And so the thing that we can pull from that is momentum is a strategy that works. Momentum is a strategy that works. There's a lot of problems with it. There's really big drawdowns on momentum. You need a decent amount of capital to begin with to make money with the momentum. But it does work, and the case most of the time is that the people that you're seeing at the top of the Robbins Cup are momentum traders. because it was created amongst a bunch of momentum traders to try and figure out who was the best momentum trader. I think I was a little bit too long-winded in answering that one, but that's the answer. I'm kind of, if Patrick Nill was able to do it for 7 years, I'm kind of surprised I haven't heard that name before. But I think so like another interesting example to bring up here is Mark Minervini. You guys remember that whole thing? So Mark is a guy that, like, he's had some big success in trading before. And he kind of built up a following. And he had an interview on CNBC where he was promoting a certain stock. And then they asked him a question like, testing him. And he couldn't answer the question. He didn't know anything about that company. He didn't know anything about that company. And basically he faked a connection problem at that point. He was like, oh, I'm sorry, I'm having trouble. I can hear you. And they're like, oh, we're not detecting any problem on our end. And then he went out. And that one incident, like, completely decimated his reputation. And that was somebody that a lot of people, and people that I know, thought very, very highly of him until that incident when it was like all of a sudden he was exposed in front of them. This is kind of the conundrum with Seth as a content creator, is that I understand there's a certain amount of randomness to it. So I'm not going to like swing for the fences all the time. Just because based on the knowledge that I have and the resources that are available to me, that doesn't make sense. It's still valuable to day trade because you learn so much about the world and the market and what's going on. It will have benefits in other places in your life. Understanding these things that I'm telling you about, the economic calculation problem and that markets require a certain amount of noise to function, kind of tells you a couple of things about certain maybe political proposals and things like that, and how you maybe should approach making decisions on those, doesn't it? You can't just kind of assume that I can think it through and get the right answer. You have to model it because these things are just too complex for us, right? They're useful to you because of that, and that's why we do it. And not necessarily because Seth thinks that you're going to become a millionaire from it. But that's everybody that comes into this space and consumes this content. That's what they want. And so they're going to go to the people that are feeding you the dream and are telling you, oh, I made $1 million and I'm going to teach you to make $1 million too. And they ignore the person that's actually telling you the truth. The thing that can actually help you in your life. Oh, wow. But I don't know. This is something that it's like I understand it. But I don't think that I truly accept it. I don't think I accept it. Like, the market is imperfect. There has to be noise. And what does that mean? That means that there has to be people that trade and lose. And it's kind of to my benefit for there to be people that trade that have no clue what they're doing, so that it's easier for me to find an edge and win, right? So I shouldn't be complaining about people not knowing what's going on and not wanting to learn these things. I think that society would be better off if everybody understood them. But that would require everybody to understand it and then accept that there has to be chaos in it and still choose to participate in it, which I don't think people would do, right? Ugh. Because given what I know, shouldn't the most logical thing for me to do to be not well, but the most logical thing to do would be to accept that most people aren't going to understand or accept it and just make money off of it instead. It's probably the most logical thing to do. And yet, for some reason, I don't really truly act in that manner, you know? Okay, let's see here. Sending you the documentation now after starting the training on the updated model. The previous one did not have any practical method of quantifying the edge due to transaction costs. So I did see that comment. It was interesting. When you used when you gave me that GitHub link, I was immediately like, oh yeah, that study. And I don't know if we were talking about it before or what, but I remember that. I remember that one. It was interesting. I don't know. I kind of feel like, you know, I want to take, you know, if you can get something that's like, hey, here's a good signal, you know, like to go long or whatever. And then you say, you back test it, and after transaction costs, it's not profitable. Okay. Well, that's still potentially useful, right? And ultimately, I don't want a robot that does it all for me. I would only want a robot that does it all for me if that robot was going to make me a millionaire. But if that robot is going to perform, you know, on par with like the way that the humans do it, then I would rather do it myself and gain all of the benefit from doing it myself and watching the market live, right? But if it can help optimize my entries, if it can help, you know, when I really do have an edge, like I know which direction the imbalance is going to be that day, and it's just like, oh, I get in long and I'm too early, right? And if the large language model can reduce the number of times that happens to me, then that's a huge win, right? So that's kind of always what I was thinking of doing with it. Although I do kind of think, well, I don't know. I mean, it wouldn't surprise me to see those kind of edges having been already arbitraged out of the crypto market is another thing, right? We're just using that one guy's model. But if you combine his methods with other models and some of the kind of features and metrics that we get through our indicators that are a little bit special, and then maybe you combine that with a large language model reading the news and things like that, you might be able to, you know, build something entirely new that does have substantial edge. So should keep digging there. It would have been useful if I had VIP status on Bybit and with market rebates, but that is not the case until I transact thousands in a day. And what you say is exactly like using the gauges. Oh, you know, I never use those. It was one of the more interesting features that I've just kind of been like, well, I can see that myself, and it's more noise on the screen, so I don't use it. Microsoft lowers AI software sales quotas. Is that why the spoos nose dived into the dirt so hard? Zelensky's meeting with U.S. envoy canceled after no real progress in 5-hour Moscow talks. Maduro could be exiled to Qatar as I always want to say Qatar, but it's Qatar as Trump warns land strikes on Venezuela coming very soon. Why is Qatar spelt with a Q? Let's ask ChatGPT this. Qatar uses Q without a Q because it's a transliteration from Arabic, not an English origin word. And English spelling rules only apply to native or historic. Okay. That was the services PMI 52.6 versus an expected 52. Better than expected. Seems to be pushing them down. And prices paid was okay, 52.6 versus 52s. Or sorry, no, prices paid was 60. Oh, actually, that's weird. 65.4 versus 68. So it was lower. So it was kind of a similar thing where the two important measures in there kind of were opposite ways. I think we'll probably see what we saw yesterday, which is like the knee-jerk reaction will be the thing, but then it will kind of continue on as though the news didn't happen. Anyways, Qatar uses a Q without U because it's a transliteration from Arabic, not an English origin word, and English spelling rules only apply to native or historically anglicized words. The Arabic sound doesn't match English QU in Arabic. Okay, it represents an Arabic letter. It's a deep back of the throat K sound. Ubular stop, which English doesn't have. English QU represents a qua sound, not all the same. So Q by itself shows English speakers this isn't a qua, but a distinct consonant. Oh, so by using Q by itself, it shows that it isn't a qua. So that's why they're saying that they chose to use Q instead of K. But then there's also a K in Arabic. If we spelled Qatar as Qatar with a K, we'd be using the wrong letter and flattening the distinction between these two Arabic symbols that I don't know what they're called. English spelling rules don't apply to foreign proper nouns. All right, yeah. Why didn't English just change the spelling? Because Qatar has been transliterated consistently in diplomatic, academic, and geographic context for decades. Huh. So it's only been decades, though, huh? That's interesting, too. Anyways, I need to focus here a second. Where is there... Yes, futures fumble on report. Microsoft lowers AI software sales quotas. That was at 718. So maybe it was indeed that. Futures suddenly tumbled just after 9 a.m. Eastern time. Oh, okay, so they are talking about that. When Bloomberg blasted a report from The Information, which cites two salespeople in Microsoft Azure's cloud unit, and who claim that Microsoft has lowered expectations for how quickly it can get customers to spend money on newer AI products known as agents after many salespeople missed sales growth goals. Corporate customers have complained that it's hard to measure the savings from using AI technology and that it can be difficult to get the AI to work perfectly in certain cases. This is important for those trying to quantify the IRR from AI. It appears to still be at or just above 0. Agents specifically. According to the report, multiple Microsoft divisions lowered how much salespeople are supposed to grow their sales of certain AI products after many of them missed sales growth goals in the fiscal year that ended in June. According to two salespeople in Microsoft Azure Cloud Unit, they added that it's rare for Microsoft to lower such quotas for specific products. Microsoft is adjusting to resistance from companies to pay more for AI, but AI has been a major boon to Microsoft's business, thanks to new spending by AI firms and Microsoft's sales of AI software. The news hammered both Microsoft and SPOOs, which insta-tumbled about 40 points on the report. Word of caution, since sell-through of AI software is one of the weakest links in the multi-trillion-dollar AI bubble, don't be surprised if we get a quick and firm denial from Microsoft in the next few minutes, which will reverse the sharp losses. Okay. So for that, I'm not seeing that, but we are moving back up. Okay, so let's see here. There's this guy named Overnight Forex on YouTube that has tested around 3, and that's not enough. You need at least 5, but 3 years worth of live testing on negative risk to reward and has come to the conclusion that a 10-to-1 negative risk to reward is more consistent on compounding compared to someone using 1-to-1 risk to reward or positive risk to reward. So is that, when you say that, do you mean, I make 1 on my winners and I lose 10 on my losers? If anyone does that by hand and not with a Monte Carlo, don't trust them. Risk reward win rate, yes, they kind of matter, but at the end of the day, a sharp is most important. A high sharp will make profiles, profits consistent, and give you a nice equity curve. Low sharp will burn your account. Well, that's the thing, you did it on Monte. Yeah, you risk 100 to make 10. Yeah, so well, by and large, so one of the weird things in backtesting that you're going to find overall is that the more that you risk, the better the strategy does, period. Like, just whatever you can do. If I come in and I'm like, okay, let's trade a moving average. When price moves above the moving average, and we buy, and when price moves below the moving average, we sell. Okay, and I'm going to use a stop of X amount or whatever, right? And what you will find is it will lose money. And you'll see that the stop, like, gets hit a lot, and that basically, like, if there even is edge in the moving average, which there's not, but that like there's just too much noise in the market, you get stopped out anyways for you to really take advantage of it, right? So then what do? You make the stop bigger and bigger and bigger, and it will start doing better and better and better. And if you just don't have a stop at all, you just stop in a reverse. So you'll always hold it until you get the opposite signal, and then you go short, right? And if you do that, then you will find that many of those moving average strategies actually do make money. But what you're also going to find is that the drawdown is so massive, like even just like a standard 1 month drawdown is so massive that no retail trading account would ever be able to hope to hold it. Okay. So I'm sure that you're getting into a similar thing with like having a really big risk reward. I usually don't test it as with like a 10-to-1. That's a little extreme. But you know what I have found overall is that it really is kind of like a, how do you show it? So like if we have a graph here, and this is R factor. So what I would say is your average win over your average loser. Okay. So what you're calling a negative risk to reward is an R factor below 1. And then this right here is P, probability. And we'll do it between 0 and 1. Okay. So it's a function like this. Right. Basically, this line is the for a given R factor, what profit would you need to get? And it actually the formula follows this. It's P equals 1 over 1 plus R. Okay. You can graph it out if you want. And basically, if you are above this line, then you're profitable. Is what it comes down to, right? And what you will often find, though, something that's kind of weird is if I make a distribution histogram. This would be like daily returns, right? Right. And so, like, how long these tails are is the kurtosis of the distribution. Okay. And what I have found is that there is a direct relationship between R and K, the kurtosis of it. So basically what that means is that the higher or the lower your R factor is, so having like losers many times your winners basically dramatically increases this far left tail. Like what you're actually doing is it's like you're taking your finger. It's like you're taking your finger and you're pushing it. You're pushing more things over to here so that more of these trades are profitable. But the result of that, of pushing that, is that this line out here gets pushed out that way. That makes sense? Okay. Now the issue, and if you've read Nassim Taleb's work, is that the higher K is, the more samples that you need. So it's really common for people to come in and say that they have a strategy that works that is based on a really low R factor, and it just wasn't back tested thoroughly enough. In a case like this, I'm really not sure I understand why Monte Carlo simulation would be like a huge benefit here. But you're getting into a situation where with, like normally, I want to have 5 years of data and tens of thousands of trades, to really understand how a strategy is performing, right? If I'm moving things over into the R below 1 area, basically, like, the number of samples that I need is like, it gets crazy. Basically, here is another graph. This is K, and this is number of samples required for a statistically significant result. It goes like this. Or sorry, if this is not K, if this is R, this is our R factor. This K would be the other way. But if this is R, once you get R below 1, it's like, so like if R at 1 is 10K, right? Then where is R of 0.1? It's probably like hundreds of thousands, if not millions of trades. Like I'm not sure if even over 10 years, I would have enough data to really prove it out. I think that what I would have to do to prove something like that is run it like 10 years across multiple assets. Let's see here. If price or liquidation is not a constraint, taking risk is basically what investors do. Yeah, there you go. Yeah, you would have a very, very high win rate, yes. But what you're gonna see from those guys is they make money. It seems like they make money every day, and then just all of a sudden one day they blow the account. That's what that does. You got to realize, like, what the kurtosis means, right? Is that by their very nature, these samples over here are very, very rare. Like, this might only happen once in a 5-year period. So to really get like good statistics about that, where you have like 50 of these, how much data are you going to need? You know what I mean? So I see some flaws in the guy's reasoning. Now, if he had some way to be able to explain why that particular factor was actually like optimal, like from some sort of algebraic, logical, or simulation perspective, then that would be more interesting. But I think what's most likely happening here is that he just way underestimates how much data you actually need to prove what he's saying. More broadly, as a retail day trader, and especially one where we're teaching that there's more edge available out there in informational edge, and that really what you're trying to do is predict imminent orders coming into the market, which is a different kind of thing entirely. You're trying to build an intuition of the markets and how certain information, like this morning with yes, I don't know why I didn't even hear anything about it on my news squawk, so I feel like I really missed that one with Microsoft, but might be they're just not paying attention very well. Like I said, I didn't sleep very well last night. But you want to, hear a headline like that and then see the order flows come out. And when you trade it, you watch things so much more closely. Like you really lock in. And so just the mere act of taking a position, even if it's a sim trade, can really help you learn. It gets the chemicals going and it builds those new brain pathways, right? The issue with having a win rate like that is that you're basically winning all the time. And so no matter what happens, you think that you're the shit. You know what I mean? And so what we find overall is, again, I will draw a lovely little graph here. Actually, let's make it a square so that we can show our space here very like this. Okay, and we'll use some text, and if this the dependent variable or the independent variable here is that, like let's just say this is K, okay, and this over here is D, which is the douchebag factor. How big of an asshole does this person tend to be and you know, how mean are they to other traders? How stubborn are they? And unwilling to listen and understand proven things about the market that we can prove with data and are like well researched in peer reviewed journals and things like that, right? And if we were to graph that, it looks something like this, right? Like the bigger, you know, the smaller that R factor is, or the bigger that stop is, the more it goes to their head. Because I mean, it makes sense. Like really, what would you think of yourself if the most hardest thing in the entire world, most competitive market in the entire world, and you're coming in and you're winning literally every time? What would you think of yourself? Right? It ruins traders. That's what it does. And it ruins you as a person. It turns you into an idiot that doesn't actually know what's going on, because the only feedback that you're ever getting is good, right? And then when that big loser comes along, do you go and say, oh, well, I blew my account. That's an inherent problem with the strategy that I didn't anticipate? No, they never say that. They never say that. They always say, oh, I had a bad day. I didn't stick to my rules. It totally works. It was a personal failing. And then they continue to act like an asshole. So it's like what I was saying earlier. Like, as if you want to go and be a content creator, there's plenty of people in the space now. So I kind of feel like, you know, telling people this doesn't really hurt me, because there's already too much competition anyways, right? But you want to be a content creator, just have a really, really large stop. And you will look like a genius because you win almost every day. And then when you lose, they just forget about it. Like the day trading community is so transient. Like, new people are coming in and out all the time, that it's only going to be like a month, and those people that remember that bad loss won't be around anymore, and nobody will ever even remember it. But if your goal is to become the best trader possible, then what you should do is you should read the news and analysis and you know, the institutional analyst reports, etc., as much of that as you can, and then watch the order flow as that information comes, and try to look for informational inefficiencies where you can predict future orders that are imminent, and see how the market reacts to that, and then trade it with an equal risk to reward. Your stop as large as your target. And that will give you the best feedback to help you train the neural network that's basically in your frontal lobe, that is basically building this intuition for how the market's going to move in a way that you might not even understand. So that as soon as you hear the headline, you know exactly what you got to do before the market even moves, and you don't even understand why. That's what you're trying to do. Equal risk reward. Because if you use those really skewed risk rewards, it trains you bad. Like, just think about if you were trading a large language model, and every time, you know, you ask it a question, it gives you a response, and then you grade the response. That's how they train large language models, right? And you always gave it that its response was good. Then what would the large language model do? It would just be a mess, right? You would just get random garbage would come out of it. This is a video. Sorry, unfortunately, I can't see links. I could probably go and look it up, but I don't really feel like I need to, because again, especially when you're talking about those strategies below 1 R factor. Ah, man, why is my speech so disjointed today? Especially those strategies that are below 1 R factor, you need a lot of data. And you said 3 years. That's not enough. 3 years, not enough. It's not the first time. It's not the first. Like the most frustrating thing that happens to me, and this happens over and over and over again. Sometimes I wonder, like, is it the same person coming along and just BSing me? The things like that. But it's not. It's not. About every 6 months, somebody will pop up on Reddit or otherwise, thinks they're a genius, thinks they're the greatest trading person ever, and you look at their risk reward and they have a huge stop compared to their target. It's usually only 2 to 1, not 10 to 1. 10 to 1 is so insane, dude. It's so insane. And I will explain all of this stuff to them, and they won't believe it. They're like, oh, yeah, but I've made money and you haven't. Yeah, blah, blah, blah. I'm so amazing. And they'll always be so nasty about it. Like, have you ever watched The Incredibles? And that the bad guy in The Incredibles, Syndrome, right? Syndrome has the dumbest reason for being a villain ever. Like, his superhero said, no, it's dangerous, and I don't like working with other people anyways. And so he held a grudge for him for 30 years and designed all of these contraptions and everything to it's really like, it seems like such a stupid reason to be a supervillain, doesn't it? And yet, Syndrome is so insidious, is the word I would use. There's something about Syndrome that is just so insidious. What he says, what he's willing to do is just like, this thing is so ontologically evil, you know? And that's the kind of behavior that I get from these people, is that they are just so nasty about, you know, this argument they have with you. They come off as insidious, and it's the most bizarre thing. So it's like I said, I'm telling you, like, if you have, you know, you win 98% of the time, it makes you an asshole if you don't really actually understand the market. Like, I can totally see, like, okay, you understand all of this stuff, you go with equal risk reward and everything, and you get really good at it, and you say, okay, like, now I've got a really good feel for it. I really have developed a good strong edge on predicting which way the flows are going to be before they happen, and I have avoided any really big losses and know when it's not working very well, and I can just avoid the market in those situations and things like that. And I've been doing that for a while. And then maybe you could size up and start using really skewed risk reward ratios like that, right? You understand what's going on, right? But if you're like actually just trading a random line and there's no edge to it whatsoever, but you're getting by because of the risk reward ratio, it literally makes you evil or something. And about every 6 months, I run into a person like this, and I get this kind of behavior where, like, especially on Reddit, it is just like the most arrogant people you've ever met in your life. And then without fail, 3 months later, I'll go back and look at them, or they'll come back to me and admit that they blew it. Every freaking time. It's the craziest thing. The one that was the worst, or the funniest, I think, was I can't analytic. Anyways, there's this guy, and I had this argument with. He wasn't quite so insidious, but it was just like, well, I got this one system, and it seems to work. And I was like, no, it doesn't work. You're just being fooled by the ratio. And he just didn't get it, man. He just didn't get it. He just didn't believe me. But I said, like, I wouldn't buy that. I wouldn't buy that. It's nonsense. And then he came back, not even a month later, was like, oh, nope, you were right. Like, it works good for like a week, and then it just blows it all at once. This robot. And he had been scammed, and then he went on this huge crusade against that scammer. It was crazy. Through live testing, he won like 200. See, that is not even close to, like, I would expect 5 years and like 10,000 trades for a strategy like that. That sounds to me like what he's doing is like he has 10 to 1, but it's also kind of more of a swingy strategy, right? Like he, you know, over 3 years, and he's only taken 240 trades. That means that he maybe takes, he maybe trades less than me, like maybe 1 trade a week in some instances. But I think that probably averages out to like, well, that averages out to 3. No. There's like 250 trading days in a year, and you say it's over 3 years. So that sounds like he takes 0.3 trades a day. There's only 240. Let's round it up to 250. 250 trades over 3 years. So that probably means that like his risk reward is large enough that, you know, it doesn't get hit for a really long time. Oh, 250 trades a year is still, that's so 1 trade a day, not even close to enough. It's not even close to enough. I'm not gonna do it. You go back and you comment to him and tell him that's not enough. Tell him he needs like 10,000. And if, you know, okay, 3 years of data, well, preferably you'd have like 5 to 10 years of data. And then you get 5 to 10 years of data, that's probably not enough trades still, right? And he might, my guess is, I'm gonna bet, was he doing it in TradingView? That's another thing. The TradingView backtester is bullshit. Okay, so this is another thing you got to keep in mind. Don't trust TradingView backtest results. Okay, cheats. But you go back and tell him like we need to test this over 10,000, and if he only gets 3 years of data, then he's got to do it against a bunch of different instruments until he has that much data, right? And then you'll probably find the fat tail in it and realize this doesn't actually work. So like if we go back to this thing, this diagram that I made earlier, where we say that where this is R and this is P, and the line of profitability is basically you know, P equals 1 over 1 plus R. Holy crap, what's going on now? Oh, I guess that's not too big of a deal. Anyways, and it goes like this, and if you're above this line, essentially, you can't have a win rate greater than 1, so it's this sliver here, essentially, right? Then you're profitable, right? And what's happening is he's coming in until it gets to the point where the number of samples that he has is no longer able to reflect the kurtosis in the distribution. And so that's why he thinks that an R of 0.1 is optimal. Does that make sense? Oops, I didn't want to do that. Let's try this again. Actually, let's do that, and let's draw it a little bit like that. E. Here's oh, I know we don't want it. We want it like that. Here is 1 R of 1. Here is P of 1. And the lower your R factor is, and then if R is equal, then your risk reward should essentially be 0.5, right? And so it's a thing that goes like this, right? And basically, as R gets smaller, kurtosis goes up. So the number of samples that you need goes up exponentially. So then we can make another one that is like this is R and this is S, right? And what he's doing is the number of samples that you need goes up exponentially like this, right? And there's a point at which, you know, the number of samples that you need, and there's this point that is like, you know, you need 1,000 trades or whatever, and that's bigger than his data set, and that's why his simulations come out with an R of 0.1 being optimal. It's a function of his data set not being large enough. Ooh, that's so interesting that it comes out like that, though. I would have never thought to do it like that, but I really do think that that's what's going on. Well, I tell you what, man, the S&P 500 sure is gangbusters, and the treasuries do seem to be getting killed here. It was kind of interesting, though, that when that news came out about the Microsoft thing, that the treasury market didn't really react to it at all. Oh, you know what it is? Okay, we were getting news. Microsoft, we did not lower our AI sales quotas. So this is actually really funny, isn't it? Because isn't this exactly what Microsoft said? Or sorry, isn't this exactly what Zero Hedge said? Is that Microsoft is almost certain to come in and deny the report? Let's read what their words were specifically. Since sell-through of AI software is one of the weakest links in the multi-trillion AI bubble, don't be surprised if we get a quick and firm denial from Microsoft in the next few minutes, which will reverse the sharp losses. Sure enough. Well, I guess the move that we should have made was to buy SPOOs. You know what? If it had been, I really didn't think that the treasuries would react. If it had been a situation where it was a treasury, so maybe I would have reversed it. Because I think that's one where they're spot on. Yeah, and you know what? I believe the story. Just because I work for these companies, and I can see the spending on AI workflows is kind of a niche thing. Like, so one of the things that I'm noticing is like a lot of software engineers, they will talk with ChatGPT, for instance, right? They have a problem, they'll ask it, they'll have it give them code, but the code that they get is kind of trash, so they can't just copy and paste it. They have to debug it and fix it and things like that, right? And then you run out of tokens, right? So, like, that's what usually happens with me. I go when I do Gemini and was like, oh, I use that until I have used all the tokens. And then you go over to ChatGPT and you do that until you use all the tokens, right? And if you really want to do something that is like truly vibe code it, you know, like I'm just going to give it the prompt and it has to get the software working correctly from the prompt, you have to have a lot of tokens. Okay. And not all companies, I would say even a small percentage of companies are actually getting the subscription or whatever that would give you enough tokens to do that sort of stuff. So like the number of people that are actually able to go in and mess around with it and be like, okay, what prompt do I have to give it so that it actually accomplishes this task successfully? Very low number of people, right? And then when you're talking about implementing this into a cloud workflow where you've done some training and you have some prompts and all of this sort of stuff that allows an agentic AI to do something regularly. So this is actually a job that is like kind of hard to get because like not very many people have experience in doing it, even though like anybody could figure it out. Anybody with cloud experience could figure it out, but you haven't done it, then it's not on there, and you can't get the agent automation job, right? So, and then when you do get that working, like how actually useful is it? Companies are all treating this as just an experiment. There's only a few companies that I've seen that like truly have like driven into this headlong and maybe it's not working for them. So I 100% believe that Microsoft sales are not meeting up to expectations and that they're kind of tempering those expectations. And that they would, well, I wouldn't say that they would outright lie about it, but you know, they have some explanation for why that's not actually true, even though ultimately it is. But I'm curious to know, why was it that the Treasuries didn't react to it on the initial announcement, but the walkback from Microsoft did seem to affect the Treasuries? That seems like a bigger deal. Granted, we're only just a little bit below 113. So I think probably part of what happened there was we did get a little bit more of a move than people were expecting. Like look at the volatility numbers, right? Like we were expecting 01 was where the implied volatility was kind of putting things at, and then from the regular session at least, right? And then you're below 113 even, so probably that tail there was all stops. Which I guess is a really long, complicated way to say that just based on how the flows are going to react and like second and third level effects and things like that, I don't have anything to tell me that it'll keep going. But I don't have anything to tell me that it will outright reverse back up either, so no trade. I think I could say that I missed a trade. I think I wasn't really actively looking to take trades today because, again, I didn't sleep very well last night. And when that happens, I tend to get emotional. I can tell when I'm in the shower, because I'll be in the shower and I'm just daydreaming or thinking about things. And I'll think about like, oh, what if there was a movie like this and it went like this? Or maybe I'm thinking about a movie or a work or whatever, and I can feel that kind of like ping in your heart that like it, you know, you had an emotional reaction to it, right? And that shouldn't happen in that situation, right? Like that's way too mundane of a, like that's how I know. So I don't trade. But I would guess that even if I was looking for a trade today, that I wouldn't have caught that one. I think that even if I was in ES, I probably would have been too flat-footed. So I'm kind of thinking now about what could I do? What could I change to catch that one? To be on that one. Well, it was. I do think that the new Squawk said it, and I just didn't hear it. I don't know. I think, because some of you guys are good at this sort of stuff, I think that if I had somebody sitting next to me and their job was just to look at that, that would maybe work. But well, let's see what the treasuries do. I'm not getting a very clear sign of a liquidity hole yet. But this is definitely the type of area where they tend to form. So let's see if it happens at 30.5 there. Dissent on Wednesday said he will push for a new rule that candidates for regional Federal Reserve presidents must have lived in that district for at least 3 years. That is an interesting change, but I feel like that's probably only like because they want a less hawkish Federal Reserve, so they want less people to come from New York, essentially. Joseph Wang says, one way to make the current Fed a little less hawkish. Yeah. I don't know how I felt about that one. Cassandra, or Michael Burry, rather, 20 minutes ago. Cassandra Unchained will donate 5% of subscription revenue during that month to a selected and vetted charity. This is also an opportunity to spread the word about charities truly making a difference. December's charity is Together California. Blah, 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 blah. Okay, that's interesting. Only 5% though, huh? So now I'm hearing a comment from AMD CEO that basically complaining about the memory shortage. I'm complaining about the memory shortage. Well, we were complaining about that yesterday. You did that on stream, huh? I was like, oh, it'd be cool to have a mini PC. Here's a mini PC that could maybe work that's like only $200 or whatever. And you know what? A couple of years ago when memory was only like maybe in some instances $30-50, and now it's like $200. That really changes the price of the mini PC. Yes. So I can only imagine what it is doing for AI companies. Oh, see, they refute. Let's see what Zero Hedge said after Microsoft refuted the report because they did update the story. CNBC quotes a Microsoft spokesperson who denies the information report, saying the company did not lower sales quota. Meanwhile, the information has also changed the title of its report from Microsoft lowers AI software sales quotas as customers resist newer products to Microsoft lowers AI software growth targets as customers resist newer products. Okay. Separately, a report from Mihihu Klein also pushes back on the report and claims that the information article looks and sounds totally backward looking, adding that it is nothing new, not an incremental negative. Well, I'm still not getting the really clear liquidity hole sign at 30 half, but it has been here for a while, so. Here's a good comment here. Peter Thiel, when 70% of millennials say they are pro-socialist, we need to do better than simply dismiss them by saying that they are stupid or entitled or brainwashed. We should try to understand why. And this commenter says, socialism is just a label they're placing on FDR's policies with Eisenhower tax rates. Yeah, that's exactly what it is. The term socialism has become diluted because of social policies. Because over the last 30 years, the biggest proposals have been about whether we should have social policy this or socialized healthcare or whatever. Well, you can do healthcare as a socialized service or as socialism. So a lot of what was proposed on that was socialism, and so Republicans took it to just calling every social service socialism. So there's one person that's been messaging me back and forth, and they were asking me a question that I think is worth talking about here. So we got like 8 minutes left. Saying, like, if the moving average is below price and you're going to go long when it goes above it, what would you want to see on the DOM before entering the trade? Like, that doesn't make sense. So the idea that, like, well, I'm going to take what I see on the DOM and the signals that I get on the DOM, and I'm going to combine it with some moving average or some other signal. That doesn't really work, because I'm coming in and I'm making a prediction of flows, right? So what I'm going to see in the flow has to match that prediction. And there's going to be things from how much of that flow is coming in the form of icebergs and how aggressive it is and how much the robots are going to respond to and pull their liquidity in response to that. There are a number of factors that I can kind of judge based on knowing what the flow is, what kind of a flow it is, right? And so part of how I determine, is that expected flow actually happening is if all of those things kind of match what I expect. So it's not as simple as you just combine two signals like that. some of these things I get questions from people, and I was like, that's like a, reveals a misunderstanding or information. Like that would be a good video. Except for I don't know how I would market and create a title and everything to like get people into it. And then I'm going to forget about it and probably never make a video out of it. But I talked about it on stream, and maybe I should have just cut that out of the stream or something, but whatever. Guys, does sure look to me like we got a stop run in the treasuries when they went below 113, and that things have kind of chilled out. So we'll see if we get further flows today. But I think that we got the most interesting stuff that we're going to get, and we can just kind of see where they take it tomorrow. I do kind of think that this Microsoft headline, like Treasury is reacting too strongly to that, and that this ultimately should be a wash. Like, I believe this story. I think it is reflective of things that I'm seeing, but you can't really prove it for like journalistic purposes, and the market is just going to move on like this never happened. So I will see you guys tomorrow. Thanks for sticking around. And in the meantime, stay excellent, team.